Welcome everybody. And obviously we know everybody online, but more for the people that are going to be watching this later on YouTube. Welcome to Passive Cash Flow for Life. This is Teaching Tuesdays, and every Tuesday for the last 1 year plus, we've been providing teaching on different things to do with multifamily in the first hour and then single family in the second hour. The idea is to, like I said, provide value, give some teaching. This actually originated from our course, Passive Cash Flow for Life through multifamily. So this was an opportunity not only to give back, but to give people kind of a bit of a taste of the teaching. And if they decide that's something they want to do and they feel comfortable with it, they can reach out to us, ask questions, with the idea being that they could take the course and then kind of start their multifamily journey and building their portfolio. Nicheole Amundsen, that is speaking tonight, is actually the originator of all this. She's been doing commercial real estate for about 30 years, very successfully, and about 11 years ago started to teach in person, and actually was a student of hers about 7 or 8 years ago. And then we took it online, and we just actually did one in person for the first one, like in 5 years, just a couple of weeks ago. So that went really, really well. But anyway, having said that, I'm going to turn it over to you, Nicheole.
All right, thank you. So he's giving me more years credit than I do. I just went over about 20, I'll be 26 years in June.
Oh,
So I'm
okay.
I've not 30 years yet.
Okay.
All right, all right, today we're going to talk a little bit about short sales in the commercial space. So I think a lot of people probably know about something about short sales in single family. And as I was going through this and trying to pull this information together, it became pretty clear that um, I was going to do short sales in kind of commercial foreclosures. But I think the foreclosures needs its own presentation. Short sales in this space, in the commercial space, are a little bit harder to come by. Because short sales don't work quite the same way they do in residential. Those of you who know, in residential, basically you are finding a homeowner that is underwater. Their property isn't worth as much as what they owe on it, and they don't have the wherewithal. They're a financial hardship. And so you work with the homeowner to work with the banks and to try, or the lender in the workout division, to try and see if you can get a short sale approved. In the commercial space, what's the same is that the bank or the lending institution is willing to take less from the property than the mortgage balance. It is a lot easier. These are not easy to find. So let me just make that clear, that these are not easy to find, as opposed to foreclosures in this space, where you can go to most any small bank and they will have a foreclosure list, and most of them are willing to just share that with you. Banks or lending institutions can't always share the information with somebody that is in trouble, because they have rights, and so it is less likely they will tell you about a short sale. I think they are the reason I'm kind of bringing this up now, talking about this topic, is as we've talked before, a lot of times, in the past, pre-COVID and right after COVID, people were paying insane amounts of money for properties that really didn't make any sense, very low cap rates. And now the cap rates, because interest rates went up, cap rates are coming up. And generally, as cap rates come up, the price that you're going to be selling a property at comes down a bit. And so I think in the next, it's probably been 6-8 weeks ago now or so, I was reading something from, it was either Goldman Sachs or one of those big finance companies, that they expect, actually it was Freddie Mac, I'm sorry, that they, over the next 2 to 3 years, they think that there's going to be over well over 1 million properties that are getting ready to reset. And so there are going to be a lot of opportunities in that space. I know it's well over $1 trillion in value that is going to be reset. So there's just a lot coming. And what we've talked about before, and I'm going to just kind of briefly say it again, is that because commercial loans typically are given for, they will give 3 to 5 years. I'm sorry, they will give like 3 to 7 years typically on a loan with a 25-year AM, and then at 5 years you have to go in and get that loan. It has to go all the way back through underwriting again, and so they balloon out every 3 to 5 to 7 years. And because prices are coming down, cap rates are going up, and interest rates are going up, I think there's going to be a lot of properties that are going to end up in a world of hurt, that they're not going to be able to bring the money to the table that they're going to need to get those loans refinanced. So what I see is us doing this week on short sales, and then in April, we'll do something on foreclosures, and then we're going to do something else on buying equity in an existing property that is going to go to that the loan is resetting and people can't probably come up with the money. So I think there's a couple of 3 ways we can go about taking advantage of this. Short sales is going to be the toughest one, I think. So you're going to have to find people who are in a bind and then work with their lender. You're going to have better luck working with small properties, I do believe, where the loans tend to come out of small banks, savings and loans, credit unions, and things like that. The big banks probably are not going to be quite so open, and certainly the majority of properties in the commercial space are, bundled up and sold off to Wall Street. And, dealing with whoever's in charge in Wall Street's probably not such an easy thing to do. So most of the time in short sales, you have to find another lender if you're going to move into another lender, if you're not going to buy something cash. In commercial, maybe not so much. What they really want to do is get that bad debt off of their books as soon as they can. So and I'm gonna, at the end of this, I'm gonna show you one of my properties. I don't think I have ever really, in the year we've been doing this, kind of went through one of my properties and just kind of showed you what the numbers look like and what we did with it. But this is a property in Portland, Oregon that was a short sale. And so I'm going to try and go through that just a little bit with you. But if you're experienced, banks may call you. And that's in fact what happened on this property with me. Is it because I already had a couple of loans with that bank? They ended up calling me and seeing if I would be interested in taking over this property. Most of the time, when you're dealing with short sales, you are dealing with a workout department, or the loss, or also called the loss mitigation. In commercial, you really want to find the commercial banker or the vice president if it's a small bank, as you're going to be working with them. Loss mitigation is just that. They're trying to mitigate the losses to the bank. Once you start getting up into commercial and the higher priced properties, they are somewhat more interested in just getting that bad debt off of their books because it impacts how much they can loan and and the total amount of bad debt. So we've already said this. You are probably going to have to bring money to the table on any commercial short sale. The question is going to be how much. So a lot of it, you're going to be renegotiating the loan balance if it's the same bank. But they're still going to want you to bring money in, and that money typically is going to be used for things like repositioning, upgrades, prepaying the mortgages, those kinds of things. So what I'm typically trying to do in those is to get the same lender to stay on the loan with me as the new owner, and to basically decrease the amount of loan that they have. So they're going to take a haircut on the loan. And then I'm going to bring in the money for closing, for rehabs, for upgrades. Most of the time, now I've probably done, I don't know, 3, 4, 5 of these, but most of the time they want you to prepay the mortgage for a year or two because the property's been in trouble and they have been having trouble getting that. And so that's a pretty common one. The good news is that it's not going to be the 20 or 25%, at least in my experience, that you normally would have to bring in for a new down payment. So where do you find these? I think one of the best things to do is to try and find lists of small, and I'm talking like 20 units and less, maybe 30 units and less owners, and send out mailings. Now, a lot of times if you now here are like 4 list brokers, right? That have reasonably decent commercial lists, multifamily particularly. And they are, you can buy, what I'd be looking for probably in these is to buy a list of somebody who's owned a property for 7 years and less, like, probably 3 to 7 years, something like that. So you're looking for something that's getting ready to reset. You're looking for a smaller property. And then you kind of going to be sending out letters. These are not the typical yellow letters that we send to residential, kind of homeowners. We are, people are looking that buy commercial property are business people for the most part, so they need to be kind of professional letters. And I would leave it open to be able to use any kind of strategy that might work. And so we talked about short sale, we talked about foreclosure, we talked about buying equity. We can also talk about, buying the LLC or stepping into the loan. There's all sorts of kind of creative things you can do to either take over the property or to own some of the property. You're also going to find, like I said, particularly the foreclosures in the banks. Now, the other thing you can do with these group of people is you can talk to the bank about buying their notes, non-performing notes. and see about, now those you're going to have to buy cash. So you need to have some cash available if you're going to go try and buy the note. The good news is that you're going to be buying it for probably 50, 60, 70% on the mortgage dollar. But you are now the bank. You don't own the property, you own the note. So you own the paper. Apartment owners associations are good places to find some of these properties. You are unlikely, or it's not highly likely, that you're going to find these properties specifically. So I would not go looking for a short sale. I would be going looking for properties that are in trouble, and then having enough knowledge about, 3 or 4 or 5 different strategies you can use to figure out which one works best for that owner and for the lender. And so you're going to have to be able to probably talk to the people who own the property to try and get a sense of what their situation is and what they might need, what they might want, right? All right. So you still have to do some due diligence in short sales. Don't think you don't. You have to know the financials. Because you need to know what the expenses are, what the property is doing, what it's going to need. I think one of the benefits now is that you don't have so many properties that are coming into trouble because they're mismanaged. It's sorry, guys. It's more because the financing has changed, right? So if you remember us talking, there's 3 ways you can change up a property, or the 3 ways they can get in trouble, or the 3 ways you can improve them. And that's improving income, decreasing expenses, and changing the financing terms. So most of the time, these kind of things that are going on right now deal with the financing terms. And that people they bought them at very low cap rates. Interest rates have gone up, and so they're going to find themselves in trouble. So you really do need to know the income, the expenses, what you're going to do to turn these properties around. You need to get a real good sense of, given the current interest rates and cap rates, where the financing needs to be, what the loan needs to be, what the interest rate and the amortization needs to be to make this work for you. You still need to do your pro forma to sort of know what the numbers are going to look like 2, 3, 4 years down the road, and kind of what things you can do to increase the income on these properties. All right. So I already said this. In commercial short sales, the bank may be willing to lend on the property, but you are going to have to bring in a down payment, or if not a down payment, if you're going to a different bank, you're going to have to bring in a down payment. If it's the same bank, you're going to have to bring in monies for other things. And you're going to have an agreement as to what you're planning to do before they're going to agree to lend. So you have to have a business plan pretty well put together in these cases. If the loan is held in-house, and on a lot of these smaller commercial or multifamily deals are really portfolio deals, meaning they are held in-house. They aren't wrapped up and sold off. So they are really motivated to get bad debt off of their books, because it impacts how much they can lend, and it impacts the ratio of what they can lend. And that's going to have can have a big effect on a small on a small institution. And so I've generally found them to be relatively motivated. All right, so in a short sale, you do own the property and you're taking on the debt, as opposed to a note, or as opposed to if you buy in some equity, you're going to own part of it. The current owner is going to have to agree to let the property go, and you or the bank may need to negotiate. So in my case, the bank called me, and then they talked to the owners of that property to be able to try and talk them into letting the property go. They may and probably will have some rules about what you can and can't do with the current owner, because that owner still owns the property, still has the deed, and the bank has a duty to work with the person who actually has the loan, whether it's in default or not. So I would let the lending institutions kind of guide you on what you can and can't do. All right. They can be hard to find and not easy to negotiate, but they can be really beneficial. And so I'm going to spend the rest of these slides kind of going fairly quickly about this property I have in Portland, Oregon. I've said this before. This is kind of my one real clear home run. So I have done a lot of other deals that are good base hits or doubles. And that's the bread and butter, but every now and again, one of these is nice. So this is a 302 unit apartment complex in a B+ neighborhood. And I bought it from the bank in 2011 on a short sale. So I already told you the bank called me and they wanted to get the owners out. At the time, there was a current loan on the property of $9,250,000. And there were 45 units down. And I've told this story, so a lot of you probably already heard this, but when I say units were down, I mean they were down, 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 down. The owner had cannibalized them to fix other units. And so they didn't have sinks, and they didn't have bathtubs, and they didn't have countertops, and they didn't have, you name it. They didn't have lighting fixtures. They were just basically a mess, right? So each of the units, so this is 2009, or 2011, I'm sorry. And so each of the units took about $12,000 to bring him back. And that also included some work that needed to be done in some of the general spaces. So the bank and I went back and forth for about 6 months, and they finally lent on it. And I bought it for $8 million at that point, which was about $26,500 per unit. The bank actually gave me a loan for $8.4 million. And at 6.5% interest with the 25-year AM, and the mortgage was about $700,000 a year. I brought in $500,000 for the rest of the repositioning and closings. The bank oversaw the rehab, meaning I was out here on the East Coast and that was on the West Coast. So before the bank would give the people who were fixing up the property another draw, they sent their people in to make sure that it was done right and that we had the inspections done and all of the correct, everything was okay with the inspectors. And so that was a real benefit to me. And if you can negotiate that, that helps a lot. It took about 9 months to get that work done. All right. So here it is again. So I have been talking about this property for a while. So I pulled in some slides, a couple of slides from other years, and then I just updated the end of 2023, so what it looked like going into 2024. So some of this is a recap. So it was about 8.9 million, including closing, what the bank gave and what I brought in. The value at 2016 was 13.5. All right. The average rents in Portland in 2018 were $900. Now, just think about this, 18 to 23. In 2023, the average rents were almost $1,800. If that doesn't tell you some of the crazy that was going on, that's almost a doubling of the rent. And it had gone down, it was off about $176 from 2022. So the rents had actually come down some. It was, we never charged that. So our average rent still is about $1,500. So those of you who know me know that one of the things I try and do is keep rents slightly lower than the competition. So people have to really want to move before they will, because they're not going to find anything cheaper. So I have to be doing not a good job, or I have to have really made them unhappy for them to want to move. But I also think I was still making a really plenty profit, and I didn't need to have that extra money put on them. Affordability is becoming more and more and more of an issue with people. And we make plenty of money, so I just didn't increase the rents as much as I could have. Plus, people can't afford to go from $900 to $1,200 to $1,500 in 2 to 3 years. They just can't afford that. So now at the end of in 2023, our gross was about 5.5 million. So at an 8 cap in March of 23, now this was March of 23, it's about 38 million. So now at the end of 2023, the NOI was 3 million, just about 3 million. So in 11 years, we've added $29 million worth of value to this property, which ain't shabby. So we've added about 300% in value. After all expenses, including debts and reserves, the cash flow was about 2.1 million last year. I'm putting aside another million of that back into reserves, and we're going to update and upgrade some units, and we're going to restripe the parking lot. We're going to do a few other things to try and freshen up these units a bit. But I still had plenty of money and cash flow. So what that turns out to is that this property makes in cash flow about $175,000 a month, or $580 per month per unit, right? So if I were to take the $500,000 I brought in and divide that by my current things, that I have about a 320% return on my money in 2023. All right. So that's that kind of property in general. There's two things, not wanting you to focus so much on the numbers there, but on the fact that the longer you hold a property. So there's, I tend to be a buy and hold buyer. In other words, once I go through all the work to buy it, I don't want to sell it. And you can see from 2011 to the end of 2023, which is 12 years, basically 12 to 13 years, what the numbers look like. It takes 2 to 3 years before you really start seeing that curve jump up. And then the curve on your returns just keeps going up. Now, I don't know that we're ever going to see, or at least for a long time, the run up in rents like we have, which is the main reason why this property is increased in value so much. But what I do know is that the longer I hold it, the better my cash on cash return is. So the harder my money's working for me. I'm paying down the debt, and I'm getting great cash flow. As opposed to people who fix things up and then sell at the end of 3 to 5 years. You just don't see the same rate of return, I don't believe. But that's my bias. So, but a couple of things in general here is don't skip on the important stuff related to due diligence in any of these type of deals. You really need to get clear what's going on. There's a reason the owner's having financial difficulty, and you need to find out what it is. You need to find out why they couldn't make it and make sure you can overcome that issue, whatever it is. Now, I just said a lot of it right now is just the financing terms under which people bought things. Something went wrong. What was it, and how do you avoid that? Don't make the mistake of thinking that you're better than the previous owner in turning around properties unless you have already done it a time or two. I think we need to get really clear on what happened to that property and make sure you can fix it, and then address that in your business plan. You also, if you're going to be using investors, you need to make sure you disclose to your investors what you are buying, the type of property it is, and how you think you're going to be able to turn it around. All right. I love these kind of properties. They offer great opportunities to buy something at a good price, but they also come with risks, and you have to identify and manage those risks. One of the things I will say is that these properties take more of your time as an owner than a lot of the other ones do, because a lot of them do have problems that you have to work through. They're going to require a fair amount of management from your property management company and from you until you get it performing. And that's kind of what I wanted to talk about with this. This is just kind of summary things. So we have an online course that's about 36 modules, it's about 60 hours. And if you buy that, it includes forever access to our online step-by-step classes. If you want to see kind of what's coming up, you can go to www.passivecashflowforlife.com events. And I have a question for you on all of this. And then I'm going to come back to this. But if we did a webinar on some topic, might you be interested if we charge something like $149 for one day or $59 for 4 hours, and kind of give us a sense of what some of those topics are? If you have questions, you can send questions to support at Passive Cash Flow for Life. And we have a YouTube channel where all of these Teaching Tuesdays go. And this one should be up by Thursday or Friday. And so I'm going to turn it back over to James, and we'll take some questions. It can be on this, it can be on any topic you want. And anybody who has ideas, if you'd be interested in kind of a webinar on topics you might be interested in, I'd appreciate hearing it.
That was great. Thanks, Nicheole. So I guess a couple of things for you that have just happened. So this is not kind of pie in the sky. So about 2 days ago, a guy sent me a deal in Ohio for 96 units completely vacant, right? And some guy that I guess didn't really know what he was doing, paid 1.3 million for it. The guy that sold it to him paid 375, which is about what it's worth. And now this guy is trying to dump it because he all of a sudden figured out, someone did the numbers for him and said, this doesn't make any sense. You're not going to make any money on this. So he's going to take about $1 million haircut because he didn't know what he was doing. Right. So if you are planning on using your money or somebody else's money or whatever it is, spend some money, get a little education. You'll be a lot happier. You'll be a lot more successful. And even though we can't guarantee that you won't lose money, chances are that you will be able to avoid a lot of the disasters like this guy did last week. Who knows? Maybe we'll buy the property for 300 grand, right? So, and we'll do something creative. Maybe we'll keep him involved or something like that. Well, I don't know. We'll see. It's a pretty big lift, so I'm not sure if we're going to do it or not. But, stuff like this really happens. People go out there and all of a sudden they get upside down and they don't know what they're doing. So, Teaching Tuesdays are great. Hopefully you find some value in it, and we hope we provide that for you. But at the end of the day, if you're going to do something serious with whether it be multifamily or single family, I can't encourage you enough to get some level of education, because what you're basically doing is you're just shortening you're shortening the learning curve, and you're also putting money in your pocket, right? So as opposed to going out and making mistakes for the next 3, 4, 5 years, you could take someone else's mistakes, right, and learn from them in 2, 3, 4, 5 months, and also accelerate your learning much, much faster so you can go bigger sooner if that's what you choose to do. So I had another example. Somebody else has sent me something about things turning over these next 24, 36 months. So somebody else sent me a deal where they're trying to get out because they're on a bridge loan and they have to sell, and they're actually selling for more than what they bought it for like 6 years ago, but they also dropped $2.5 million into it. So they're going to lose money, but they put themselves in a position where they speculated versus doing the numbers. They didn't have education, right? And they bought this thing, and now they're going to lose money for their investors. So I feel horrible for them, not horrible enough that I'm going to pay them their price, right? But, you just need to be really, really careful when you do something like this, because, whether it's $1 or $1 million, like Nicole's always said, she hates losing any kind of money, and I couldn't agree with her more. So I think that's about it. So in terms of questions, what kind of questions about this, about multifamily in general? Nicole, do you want to stop sharing and we can see the pictures and stuff?
Yeah, I just want to bring people back to if you'd be interested in something like that. So
Yeah, absolutely. So let me find the chat. So if you want to put something in chat, if you'd be interested in that, you can send it directly to me if you want to email me, or send it directly to me in chat, or just we'd be interested in your feedback. Obviously, we're trying to do the best we can here in terms of providing value. So whatever you guys can share with us will be fantastic. Any questions on anything multifamily related?
Wayne
So
has a
let
question. Just in general, in acquiring a project or a multifamily, sometimes the opportunity presents itself to acquire the entity that owns the property and everything in it versus just starting over from scratch and acquiring it under my own LLC. What are the pros and cons of each?
a couple of things. Number one, if people like to just kind of buy the LLC, because they think they won't have to pay the recording fees again in the state, like you've sold it, like you can hide some of that. But with some of the new laws where you have to report who owns something, then anybody who owns more than 25% of something is going to have to be sharing that with the IRS. That's not going to stay hidden too long. The other thing is, if you buy an LLC rather than coming in with your own, you are buying all the liability that goes along with that LLC. So that's the biggest drawback, is that anybody who's ever sued or wants to sue or anything that's happened in the life of that LLC, you now own that liability. So if I would rather not buy the LLC. I will buy into an LLC with one of my own companies, but I don't want to just buy the LLC most of the time. That answer that?
Yep, it did. Thank you. A lot of that, I guess the biggest piece, like you mentioned, was all of the liability that could come along with that. And it's always been presented to me as a way to kind of save on the recordation fees, but the unknowns and the downside far outweigh that.
Well, it certainly can, particularly in the past, save on recordation fees, but it's also, if somebody caught you, you would be in trouble, I am sure, with the state, because you're actually changing owners. So and it is much more likely you're going to get caught now because of the new IRS rules. So, I guess that would be my comment there with that. James, what do you think? You're on mute.
Sorry, I was answering Studley's question. So it's interesting that you bring that up, because this building is in Ohio, and several years ago, this was very, very common, from what I understand anyway, in the commercial space for Ohio, to be able to just say, you know something, you just buy the entity, because I don't know exactly how the Ohio property tax system works, but this was very common from what I understand. But to Nicole's point, if it's so common that all these people are hearing about it, you would think that, the state or the government is going to hear about it too. And now with these new financial regulations and stuff like that, at the end of the day, if the deal works, it's got to work with the closing costs in there. And if it's only going to work if you save the closing costs by buying the LLC, personally, and again, it's just me, I don't think it's worth it. You don't know who's going to come out of the woodwork, further down the road. So maybe you save whatever, 500 grand in recording taxes. I'm just throwing a number out, totally making it up, right? And then somebody comes along and sues you, and you don't have enough insurance, and they sue you for $1 million. Your savings doesn't look so hot now. So I personally don't think it's worth the risk, but everyone's different. I know in single family they do that, but the LLC is like a week old or 2 weeks old or something like that. So there's not a lot of time for it to accumulate any kind of I guess, bad things. And Nicole, you would know more about that, or Jane and Sharon, in terms of single families where they sell the LLC.
I'm going to let Jane take that. Where's Jane? Did she hang up?
No,
No, we're switching computers. So you caught us off guard there a little bit. Yeah, I think the LLCs, there's a little less liability issues with that, but we've never just bought one through the LLC.
Right.
We started.
So I have just a general question. Are you interested in me sharing more of kind of the deals that I've done, or would you rather just kind of let's talk about how you actually work through different situations like we did? Anybody?
Both is fine.
Okay, thank you.
And then Studley,
Anybody else? Go ahead, James.
I was going to ask, Studley has a question in the chat. Is that for a webinar, like a extensive, like half day or 1 day webinar, Studley? Or is that a question you're asking now? He's saying, or I'm sorry, they're saying, how would due diligence be done correctly for out-of-state properties?
Oh, it's a question for now, but I mean, I definitely, I mean, if, because it's not, and I know it's a layered question, so, you know, if we can get a brief answer for now, but I mean, definitely for future topics to get into the nitty gritty potentially.
Sure.
I'm gonna let you take that, James.
In terms of how to do due diligence correctly for out-of-state properties?
Uh-huh.
Well, at some point, you're gonna have to, I know there are companies out there that would do the due diligence for you for a certain price. I would still want to go and at least do, I guess, my own due diligence. I'd put a team together, plan out 2 or 3 days, if that's what it's going to take us, depending on the size of the property, and go, talk to the local municipality, go to the police department, go to the government center, do my own due diligence by doing mystery shops, checking out the building in and of itself, is the roof okay? That's just my own personal opinion. Again, I know you can do it without being there yourself. My comfort level is still, and Nicole, you have more property, farther away than I do. So I would still want to go. That's just kind of my thing. But any other comments, Jane or Sharon? Or Jane, I know Sharon, you guys do a lot of stuff out of state.
Yeah, I didn't hear the question. We're having computer issues. The camera won't work on.
How
So
would you do it?
I would say on due diligence, you can do some of it before you ever leave. So you can do a lot of the market due diligence, you can do a lot of the financial due diligence, you can do a whole lot, probably a third to a half of the due diligence before you ever leave, to try and make sure that it looks like reasonable. But then I agree, you need to put boots on the ground.
Jane, the question was, how do you do due diligence if you're out of state?
I think Sharon's here, but I don't see Jane anymore.
I think they switched computers so Sharon could present, but I think they're on mute again. So they're presenting next, so they have to actually switch the computers, which is kind of why we're doing
Yeah,
this.
we're having problems with our, we can't get the camera on, which I think will mean we can't get the PowerPoint on. But anyway, yeah, we do a lot of it remotely. And then, again, we don't put the keys in the ignition until we smell money. So, and a lot of times we don't, it's not like we have to, drive to Indiana all the time or drive to North Carolina. But, we have pretty good boots. And then, we're just very specific with what we, a video or FaceTime or, there's so much technology out there, you really don't have to go. But you want somebody on your team, lessons learned, ask us how we know. You don't want an agent who's trying to sell the house that they listed. You don't want them to kind of, take the pictures because they might, and they might just show the good stuff and not the bad stuff. And then you might, have that issue where you didn't know about some stuff. But typically we have our team or people we know or people that are working for us, and they will do the kind of the FaceTime or take really good pictures in a video. We don't do pictures anymore for the most part. We do videos. Again, ask us how we know, because you could take a picture of a totally different house without the address on the front and say that it's, completely beautiful and rehabbed, and it's not. So again, just lessons learned. So now it's video, FaceTime, and some of the technology.
That's interesting because when you said video, I thought it would be for, okay, so you can comment as you go along, you can do a lot more because you're panning, you can freeze the picture and stuff like that. I never thought that someone would actually switch houses on you and actually video or take pictures of a different house. That's crazy.
They didn't quite get the rehab done that they should have, so they had the bright idea to show something that I think they were working on 2 of them at the same time. But again, like they have to show the video walking to the mailbox, 123 Main Street, then walking
Right.
to the front door, 123 Main Street, in the house, and then kind of continue on.
I remember once in the way distant past, when I was just getting started, that I had bird dogs, and I'd have them take pictures, of the house, up the street, down the street, across the street, that kind of stuff. And they neglected to take a picture of the back of the house, which was non-existent because it had burned out.
Oh, jeez.
And so I didn't know that. That was kind of one of my lessons learned kind of things that it's really kind of amazing what people will do and not do. It's just kind of it's one of the reasons my bias is probably more towards being there myself a lot of times, just because I've had more than one of those.
And Rita, these are great. So Rita had recommended for webinars, possibly a beginner level, sorry, I can't talk, beginner level purchasing your first large property, raising funds, out-of-state purchasing, value add / rehab costs per unit, maybe a template on furnishings, building partnerships, stuff like that.
Wow, those are good ideas. Thank
Yeah.
you.
Thanks, Rita. Those are great. Make sure I copy those down. Put that somewhere. What else? Well, here I-
Questions about anything real estate at this point? We've got about, what, 5 minutes, 4
Mhm.
minutes?
Yep.
One more question, and then we'll turn it over to our partners here.
Wayne has one last question. Once you acquire a property and it's time to start operating, how do you set up banking?
You're gonna take, so if I'm closing, somebody on the team is gonna be there. And yeah, we typically, if it's a larger property, we're gonna have an operating account. We're going to have a reserve account. We're gonna have a savings account for the residents who are, putting down deposits, because you can't mingle those funds. And we may or may not have a small petty cash department, although probably not. We'll probably just have a debit card with a small balance on it. So, and the property management company is going to be on those if it's separate accounts, and I'm going to be on those accounts. But I'm not going to write any checks off of them. I'm just there as an admin, so I can actually watch what's going in and out of the property. Is that what you're asking? So
Yeah,
is-
that's it.
so-
And
so-
sometimes if you're retaining the current property manager, they're already operating the property. Do you shut those accounts down and start yours all over? And just the administrivia that goes along with that. I
If
guess
it's
it can be a big deal, but once you get used to doing it, it's not that hard. Just wanted to know the mechanics.
if it's a small property, most property management companies want to use their accounts. And I'm probably okay with that. But what I am going to do is do unannounced spot audits with my bookkeeper to make sure that things are getting recorded correctly. If it's a larger property, I want my own accounts. And that's just kind of the way that goes. Because if I have $50,000 to $100,000 going through an account every month, I want my own account. I don't want chances to get it messed up. I think we need to sort of leave it there and turn it over to Jane and Sharon. And I'm going to mute myself out and I'm going to turn it over to James and then Jane and Sharon. Thank you, everybody, for coming.